What is the delta of a butterfly spread? Have you ever wondered how a butterfly spread works in options trading? Today, we will discuss the delta of a butterfly spread and how it plays a role in risk management. The delta of a butterfly spread is the overall sensitivity of the entire position to changes in the price of the underlying asset. Essentially, delta measures how much the price of the butterfly spread changes for a $1 move in the underlying stock. To create a butterfly spread, you use for options contracts at 3 different strike prices. Typically, you buy one option at a lower strike price, sell 2 options at a middle strike price, and buy one option at a higher strike price. All options have the same expiration date. This setup aims to profit when the underlying price remains near the middle strike price at expiration. It offers limited risk and limited profit potential. When you first set up a butterfly spread, its overall delta is usually close to 0. This means that the position is not very sensitive to small movements in the underlying asset price. The long options at the wings, which are the lower and higher strikes, have positive and negative deltas, respectively. However, these effects tend to balance each other out. The 2 short options at the middle strike have deltas that offset the wings, resulting in a net delta that is close to 0. As the underlying price approaches the middle strike, the delta of the butterfly spread can increase slightly. However, it still remains relatively low compared to strategies that are more directional. As expiration nears, the delta profile becomes more pronounced. If the underlying price is near the middle strike, the butterfly's delta may move away from 0. This reflects a higher probability of finishing into money at that strike. In practical terms, traders often use butterfly spreads when they expect the underlying stock price to stay within a narrow range. The low delta means the position is not highly sensitive to small price changes. This limited delta exposure helps manage risk. The position is less affected by minor price fluctuations, allowing traders to focus on capturing time decay and volatility behavior. If the underlying price moves significantly, adjustments can be made to the butterfly spread to maintain a delta-neutral position or to achieve a desired delta exposure. Overall, the delta of a butterfly spread is generally close to 0 at the outset. This characteristic reflects its market-neutral stance and limited directional risk. This makes it a useful strategy for traders who aim to profit from price stability rather than directional moves in the underlying stock.